This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, August 12, 2026, and this is the New York session. Now, let's get into it. The US dollar is tentatively strengthening, gold is climbing, and the Fear and Greed Index is sitting at a historic low of 14 out of 100. We are in a state of extreme risk aversion, yet volatility metrics like the VIX remain surprisingly subdued. How does the market reconcile this panic with complacency? Let's look at the data. It's a dangerous decoupling. You have the Fear and Greed Index at 14, a level that screams capital flight, while the VIX sits at 15.46, right in the middle of its lower range. This isn't calm, it's suppressed tension. Capital is aggressively fleeing risk assets for the safety of the US dollar and gold, regardless of the fact that today's headline CPI came in exactly as expected at 3.4% year-over-year. The market isn't reacting to the print, it's reacting to the implication. With core PCE still at 3.29%, and the 10-year to 2-year yield curve flattened at just plus 0.48 percentage points, the Fed's path is obstructed. That flattening yield curve confirms that structural bid for the greenback isn't going away.
And that bid is visible in the mechanics. Look at dollar-yen. It's at 159.4255, hovering mere fractions away from its 5-day high of 159.4625. The pair rallied from 156.667 earlier this month, and now we're seeing exhausted selling pressure. There is no pullback support here until new liquidity arrives. Meanwhile, on the flip side, euro-dollar is at 1.15353, testing the absolute lower bound of its 5-day consolidation channel, which started at a low of 1.15177. We are in a compressed range of only 63 pips between that low and the high of 1.1581. There is literally zero room for error on either side.
Which brings us to the positioning that makes this compression explosive. Leveraged funds are massively short euro, holding a net position of minus 52,205 contracts. That is a near total capitulation of euro longs among speculative traders. Simultaneously, they've added plus 4,438 net long contracts to the dollar index. This isn't just sentiment. This is institutional front-running. The smart money is positioned for continued dollar dominance, but that massive short book in euros creates a latent, explosive potential. If that 1.15177 support breaks, we aren't talking about a slow drift. We are talking about a mechanical squeeze.
But let's not ignore the VIX. It's at 15.46. which is dangerously close to the bottom of its 5-day range of 14.77 to 18.43. Options markets are underpricing the risk associated with that 14 out of 100 fear metric. We are seeing a scenario where equity volatility is contained, but FX markets are pricing in significant tail risk. The trade-weighted dollar index actually declined by negative 0.45% week over week, to 119.6, yet leveraged funds are adding to DXY longs. That divergence between the spot index weakness and the institutional positioning is the crack in the dam. If the VIX breaches 18.43, the cost of hedging those crowded pound longs, which stand at plus 38,174 net, becomes prohibitive, forcing a cascade of exits.
So we have a structural preference for dollar safety, driven by the flattening yield curve and sticky core inflation, clashing with a technical landscape that is running out of room to breathe. The euro short squeeze potential and the dollar-yen ceiling resistance are two sides of the same coin. Liquidity is drying up at the edges of these ranges.
Let's turn to the calendar. Today, the US Consumer Price Index is the central pivot. On Thursday, we have initial jobless claims and the Producer Price Index, and Friday brings retail sales and business inventories. These are the gears that will drive the next leg of this CPI narrative. Beyond the CPI, there is noise from the commodities complex that is feeding into our FX mix. Headlines indicate that silver's rally will face a key test today with the US CPI expected to influence Fed rate hike bets, while investing live notes that cash equities. Monolith Market adds direct access to listed global shares. Additionally, reports note that Easy Markets reports more cautious trading as gold and oil lead Q2 activity. How does this silver and oil context affect our FX crossbears? It reinforces the safe haven hierarchy. Silver is a secondary play on volatility, but gold is the primary proxy. Gold is up 0.7% to 4,401.94, approaching that 5-day high of 4,435.4. When silver is facing a key test and trading activity is becoming more cautious, it confirms that capital is rotating into non-correlated stores of value. This supports the dollar bid because the alternative, to hold risk assets, is currently unattractive. The cautious trading environment described by Easy Markets aligns perfectly with the negative non-farm payrolls change of minus 23,000 we're seeing in the labor data. Growth is cooling, inflation is stuck, so the dollar wins by default.
Visually, that safe haven bid is validated by gold holding firmly above its established support floor of 4,366.44. It's trading at 4,401.94, which gives it roughly 35 points of cushion before that technical invalidation. But look at the laggards. Cable is at 1.35055, consolidating directly atop the psychological 1.35 level. It has failed to reclaim the 5-day high of 1.35308. Buyers are absent at higher yields. The technical reality is that cable is leaning heavily into support, and without a decisive break above 1.353, any upward movement is technically a bear flag continuation, not a reversal setup.
And that is where the vulnerability lies. The pound sees a net long position of plus 38,174 among leveraged funds, with a weekly change of plus 37,416. That is a crowded long position. With cable at 1.35055, a break below 1.35 could trigger a cascade of stop losses. Unlike the euro shorts, which might cover, these pound longs are chasing yield in a risk-off environment. They are exposed to cascading stops if dollar strength persists. The divergence between the cautious trading in oil and gold versus the aggressive positioning in pound is a mismatch waiting to resolve.
I agree with Grid on the structural weakness, but I challenge CIPHER on the timing. You're focusing on the 1.35 level, but don't overlook dollar CAD. It's at 1.3929, up 0.6%, trading near its 5-day low of 1.39153. Here is the anomaly. Canadian building permits surged 18.5% in June versus a 0.8% estimate. That is a massive positive fundamental surprise for the loonie. Yet, Canadian dollar remains weak against the dollar. This suggests the market is prioritizing dollar strength over commodity fundamentals. The risk here is that if the dollar pauses, Canadian dollar could snap back violently. But right now, the dollar is winning so hard that it's ignoring solid Canadian data.
That dollar CAD example is the perfect illustration of the Fed put narrative breaking down. Normally, strong domestic data supports the local currency. Here, dollar CAD is pushing higher despite Canadian building permits beating estimates by a wide margin. It tells us that the dollar's safe haven status is currently overpowering regional economic fundamentals. The flat yield curve is suppressing risk currencies globally, regardless of their individual health.
Let's drill down into euro-dollar. We are at 1.15353, essentially at the edge of a cliff. Grid, you mentioned the compression. What happens if we break lower?
If we break below 1.15177, we open the door to deeper downside. The current price is sitting just 1.5 pips above the 5-day low. The structure is brittle. Resistance at 1.1545 to 1.155 is currently impenetrable. We've seen the pair reject that zone repeatedly. Until we see a daily close above 1.155, the path of least resistance is sideways or lower. The technical bias is strictly bearish within this channel.
But Grid, you're treating this like a textbook chart. With minus 52,205 net shorts, a break above 1.155 is not just a resistance rejection, it is a mechanical force majeure. The lack of buy-side liquidity means that if the CPI narrative shifts even slightly toward dovish relief, those shorts will be forced to cover simultaneously. You won't get a gentle move to 1.1581. You'll get a gap move. The volume profile is thin right now, waiting for the CPI release, which means any directional trigger will cause slippage.
And don't forget the VIX context. If euro-dollar breaks 1.15177, it likely drags the broader risk sentiment down, potentially spiking the VIX toward that upper bound of 18.43. The dissonance between the low VIX and high FX fear means that a technical breakdown in euro often precedes a volatility explosion in equities. The euro isn't just a currency pair, it's a barometer for global risk appetite. Right now, that barometer is pinned to the floor.
What about dollar-yen? It's at 159.4255, practically at the wall of 159.4625. Is there room left to run?
Technically, no. The pair has rallied from 156.667, and at 159.4255, it is testing exhaustion. Support sits at 156.667, but we are far removed from that level. The immediate support is simply whatever price was last traded. There is no obvious pullback target until we hit that 156.667 area, the Bollinger Bands. If we were looking at a standard deviator, would be pinching tight, indicating an imminent expansion, but for now, it's a ceiling.
Positionally, it's worse. Speculative shorts on yen stand at minus 60,825 net. The market has fully priced in continued dollar-yen upside. This crowding leaves the pair vulnerable to violent reversal if U.S. yields soften post-CPI. If the 3.4% CPI is interpreted as enough is enough for the Fed, those 60,000 contracts could unwind instantly. The risk/reward for chasing 159.5 is poor when the positioning is this extreme.
Exactly. The flattening yield curve at plus 0.48 percentage points is the check on this rally. If the CPI data, while meeting expectations, hints at core stickiness that prevents further hikes, the real yield advantage narrows. Yen carries near zero yields, so if the dollar yield premium shrinks, the carry trade becomes less attractive. We could see a rapid rotation out of yen shorts, sending dollar-yen tumbling back toward 156.667. Finally, let's look at gold. Gold is at 4,401.94, up 0.7%. It's near the 5-day high of 4,435.4. Is it topped out? It's not topped out. It's waiting for confirmation. The fearful sentiment at 14/100 drives flows into gold. As long as the fear and greed index remains below 20, the bid for safe havens remains intact. The 4,401.94 level is holding, but the key is whether it can clear 4,435.4 on volume. If it does, we enter uncharted territory. If it rejects, we retreat to the 4,366.44 support. Given the tentative nature of the dollar described in the headlines, gold is acting as the ultimate insurance policy.
Technically, 4,435.4 is the resistance. Below that, 4,401.94 is mid-range. The support at 4,366.44 is robust. The price action suggests a symmetrical triangle forming if we view the 5-day range. A break above 4,435.4 confirms bullish momentum. A break below 4,366.44 confirms a distribution phase. Currently, we are holding the midpoint indecisive but supportive.
So we have three distinct battles. Euro-dollar is a short squeeze waiting for a spark at 1.155. Dollar-yen is a crowded carry trade hitting a ceiling at 159.46. And gold is a safe haven bid testing 4,435.4 against a strengthening dollar. The common thread is the flat yield curve and the fearful sentiment. All three pairs are dependent on how the CPI data is digested, not the raw number, but the market's interpretation of it.
To summarize today's setup, first, the dollar is structurally favored by both institutional flows and safe haven demand, despite a weakening trade-weighted index. Second, euro-dollar is critically short, making any technical break above 1.155 a potential volatility event. Third, cable's crowded longs are vulnerable at 1.35, especially given the lack of fundamental support compared to the Canadian dollar. And fourth, gold is holding firm near 4,401.94, acting as the barometer for this extreme fear. Tomorrow, watch the jobless claims and PPI for clues on whether this fear is justified or overstated. Stay tuned for updates as the data hits. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.